The two main areas of accounting that we'll be dealing with can be broken down into two categories: managerial accounting and financial accounting. Managerial accounting you'll be dealing with next semester primarily, but just to give you an idea of what managerial accounting is all about, managerial accounting is really the accounting within a business. It's how you manage your business in the sense of it's how you create budgets, it's how you decide how much you're going to sell a product for. Managerial accounting is really about how you run your business and the reports you need to run that business. It's also called private accounting when you're referring to managerial accountants. What we'll be working primarily on this semester is financial accounting. Financial accounting, the end result is basically financial statements, which we'll detail quite a bit in the next few chapters. But financial accounting is about presenting reports to those external users we discussed in the previous section. The reason we're coming up with these financial reports is so that those end users, those external parties outside of the business, can make decisions about whether or not to invest in your company, if you're a bank, to give a loan to the company, if you're a customer, to do business with the company, all of those things that we discussed in the previous slides. As it says in the second bullet point here, the objective of financial accounting is to provide relevant and timely information for the decision-making needs of users outside the business. So again, financial accounting is really at the end result of it all is financial statements so that those end users can make decisions. It's published to outside parties. It is solely, well, it can be used for internal purposes, of course, but it is primarily geared toward those external users. Now let's talk a little bit about ethics. This chapter has got a lot of little sections in it because it is chapter 1, it is an introductory chapter, so it is little bits and pieces as we go through it. So we're going to be switching gears quite often throughout this lecture. Let's discuss ethics a little bit. Believe it or not, accounting is considered one of the most ethical professions. I joke, but in truth, you have to be pretty ethical to be an accountant. You're privy to a lot of financial information. You're privy to private information, information that has not gone public out to the world yet. Accounting, you have the core of the business. So ethics are really the moral principles that guide the conduct of individuals. With that, the AICPA, which is the American Institute of Certified Public Accountants, as well as the IMA, which is the Institute of Managerial Accountants, both actually even publish ethical guidelines for accountants, which I'm going to show you here. We'll look first at the guidelines for the Institute of Management Accountants. As you can see, it's the Standards of Ethical Conduct. And they seem pretty simplistic. Maintain an appropriate level of professional competence. I would hope you'd want to be competent in your profession. Refrain from disclosing confidential information, avoid conflicts of interest, and communicate information fairly and objectively. None of those seem too difficult, and they're pretty general guidelines. The AICPA, which again is the American Institute of Certified Public Accountants, has very similar guidelines, but they're more geared to the public because as a certified public accountant, you're really looking more towards serving the public's needs. So the first one is exercise sensitive professional and moral judgment, act in a way that will serve the public interest, honor the public trust, perform all professional responsibilities with the highest sense of integrity, maintain objectivity, be free of conflicts of interest. Some of these sound pretty familiar, right, from the previous one. They overlap to some degree. Observe the profession's technical and ethical standards and continually improve competency and quality of services, and use ethical standards when determining the scope and nature of services to be provided. Okay, none of those are anything that should be surprising in any way. They're there for us, though, because there are times when there are what you might want to consider gray areas in accounting, and really these are here to guide us towards what is the correct decision. With that, there's a couple of ethics cases that I usually provide to my live classroom. It might be a little bit hard to see. It does get cut off a little bit in this screen. Let me see if I can make it a little bit smaller here for you. Okay. So the first ethics case I'd like to look at is this one. It's this Lauren Smith. Lauren Smith is the controller for Sports Central, a chain of sporting goods stores. You know what? Rather than reading this, I'm going to let you guys read it. I'll scroll a little bit as we go along. And then I'll just give you a few seconds to read it. You can pause, read the page, and I will scroll up in a minute. Okay, once you're done reading this, what I'd like you to come away with this is actually what Lauren has done is fine. There's really no problem in using her uncle's shopping plaza. That would be a conflict of interest, as was discussed in both the IMA and the AICPA guidelines. However, if she were to disclose to the decision-making person about who is going to what location to use for the shopping plaza, if she were to disclose that that was her uncle, it would have been completely fine. But the point is that she has to maintain her integrity and she really needs to maintain her professional distance from the scenario. It is completely fine to have used the Uncle Shopping Plaza, but once it appears that you might not be as ethical a person as you can be, it's really hard to regain that trust. So let's look at the second ethics case. As I mentioned, you can pause this, read through it. I'm just going to scroll through it. You can see where this might be a gray area. Okay, so what John's doing here, it would be completely fine for John to try to compile additional data that might save his friend's job. However, it's not okay for him to hide the information that he has already found. Now, were I John, I might say, here's the reports, they are 25% down, but can you please wait and let me compile some data that that might keep the Phoenix location open. And that would be fine, but it's not okay that he was hiding the information. Okay, let's go look at the third and final one. Okay, I think this one's actually kind of entertaining, to be honest. I'll scroll through it again, just pause to read it, and I'll discuss. Okay, now my first question to you is, would you hire this employee? Would you hire this employee who just disclosed confidential information to you in an interview? Probably not. I would hope not. Not only did he disclose confidential information in an interview, he's just proven that he's untrustworthy. It's just, there's no good side to this one. So this one's a little bit clearer. It's a little bit more black and white than the other scenarios were. But ultimately, you should never disclose confidential information, and that is in both the AICPA and the IMA's reports. All right, let's get back to the slides. I left these slides in here more for you to review as you choose to, more than anything. I just wanted you to see what happens when some of these ethics go wrong and some of the results. So you've got AIG here that used sham accounting transactions to inflate performance. What happened? The CEO resigned, executives criminally convicted, and AIG paid $126 million in fines. You've got Enron here, which they fraudulently inflated their financial results, and the bankruptcy. Senior executives criminally convicted over $60 billion in stock market losses, not to mention a death or two along the way, at least one suicide. Now, there's several of these slides. You can read through them as you like, but really you can see how, when accounting can go wrong, how tremendous the impact is. You're talking about criminal charges, you're talking about multi-million, sometimes billion-dollar fines, and you're talking about the loss of people's, the loss in trust of accountants as a whole. Because what happens here is, yes, there's CEOs and chairmen and things of that, people of that ilk committing these frauds, but along with that, you've got accountants playing with the numbers. So it takes a big hit to our profession when you have these types of things happen, but regardless, there are a lot more good accountants than there are bad accountants, but when it goes wrong, it can go really wrong. Okay, let's look at opportunities for accountants. As I may have mentioned before, you've got public accounting, you've got private accounting. Public accounting is really for those for financial accounting more so than managerial. Public accountants are usually designated by certified public accountants, which you may or may not have heard of. I hope you have. And your interest is basically you're serving the public. You're helping produce financial statements that are for those external shareholders. Private accounting is, again, those managerial accountants who work internally at a business, producing the reports and the budgets and things of that nature in order necessary to run a business. Just to give you an idea of what some of the salaries are that are listed here, this is straight from the book, this information, so I wouldn't necessarily say it's relevant to this metro area that we live in because I couldn't tell where this data was from, but I'm going to have to say it's probably from across the United States, which means if you do live in this New Jersey, New York area, the numbers are actually probably on the lower side. But you can see some of the salaries for private accounting and public accounting, some average salaries. Now this information is available online as well. One of the more popular websites for this kind of information is Robert Half. If you're interested, it's Robert, and it's HALF, half.com, and they've got a lot of information about salaries for accountants, as well as they can show you many of the different types of jobs that and career paths that are out there for accountants. Okay, so let's talk about some of the rules. The rules which all accountants in the United States play by are actually called GAAP, which is Generally Accepted Accounting Principles. Generally accepted accounting principles are the rules that are stated, that are created by the FASB, which is the Financial Accounting Standards Board. They're the ones who basically come up with these rules, and they're the accounting rules that all businesses producing financial statements must go by. They must follow in order to produce the financial statements. So the FASB basically, not on their own, they're not in isolation coming up with these rules. They've got a tremendous number of people adding their opinions and stating their facts and weighing in basically on all of these GAAP decisions. But ultimately, it is the FASB's jobs to explain GAAP, to come up with GAAP, as well as to explain it and interpret it for the various industries. The International Accounting Standards Board is non-U.S. So if GAAP and the FASB are U.S., the International Accounting Standards Board controls most of the rest of the world. It's the international equivalent of FASB. Now, the International Accounting Standards Board, something that's not on the slides here, controls what's called IFRS, which is the International Financial Reporting Standards. The International Financial Reporting Standards are quite important, even to those of us who are still in the U.S. Now, the International Financial Reporting Standards are used by a very big portion of the world. Those IFRS are the guidelines, is the international equivalent of GAAP. So it is the guidelines that most countries, most westernized countries, and most of the countries you would think of, most European countries, many Asian countries, they all use IFRS. And they do this because they want to be working in a global economy. They want to be financial statements from France should be comparable to financial statements from Germany. Okay, you don't want everybody playing by different rules. You want everybody playing by the same rules, so somebody could invest in a German company just as easily as they could invest in a French company by looking at the financial statements and looking at them comparatively. Now here's where the U.S. has a problem. The U.S. follows its own rules, which are GAAP, as I mentioned. So a U.S. company's financial statements is going to be different than a French company's financial statements because they're following different guidelines. Now the guidelines aren't dramatically different from one another, but there are enough differences that one can't be compared to another very easily. So what happens here, what's happening right now, right this minute, is the International Accounting Standards Boards and the FASB are working together to have the U.S. start adopting IFRS. So U.S. GAAP at some point will probably go away as it stands, and IFRS will be taking over. Now this information, the things that are relevant to IFRS, have already begun to show up on the CPA exam. It's something that they've been working on for a number of years at this point, and they hope to have a consensus on on the U.S. switching over to IFRS within the next 5 years or so. There are some roadblocks along the way, and we probably won't adopt IFRS as it stands. We'll adopt some modified version of IFRS. But the idea is that we want our U.S. financial statements to be comparable to those of foreign countries so that investors can look at them comparatively and decide which company they want to invest with. Of course, there are many people that are for U.S. GAAP and keeping U.S. GAAP, and there are many people for going with a more international IFRS. But it does definitely look like we're pursuing the IFRS path.